Following the sharp rise in volatility in the first quarter, steep falls in equity markets from their January peaks, and a rise in bond yields, a degree of stability returned in the second quarter. The broad indices for global equities were largely unchanged. MSCI World returned just over 0.5% over the quarter, while US Treasuries were broadly flat. However, this masked some significant divergence across markets. In equities, emerging markets fell by 8%, compared with the top performing major market, the UK, up by over 9% in sterling terms. And the US continued its strong relative performance, up 3.3%. The Chinese equity market entered bear market territory with a fall of 20% from its January peak to the end of June, including a fall of 10% in the second quarter. In fixed income, emerging market dollar debt fell by over 4%, and credit generally came under pressure, with corporate credit spreads widening. The most notable moves, though, were in oil, up 13% in the quarter, and currencies, where the dollar strengthened materially, around 5% against the majors and by dramatically more against several emerging market currencies. The key drivers during the quarter were a more hawkish Federal Reserve and aggressive moves by Trump in trade disputes. The Fed responded to stronger growth in the US and further falls in unemployment by increasing interest rates again, the seventh rise this cycle, taking Fed funds to 2%, and by changing its forward guidance on rates, introducing a fourth projected hike in 2018 and 3 for 2019. If implemented, this would take rates to or slightly above the Fed's long-term neutral rate. In combination with quantitative tightening, this would be a contractionary policy for the first time since the financial crisis. Now, this was a major factor behind the dollar's surge, coming at a time when other big central banks are maintaining ultra-loose policy. Indeed, the European Central Bank became slightly more dovish, as it provided guidance that interest rates will remain at their current negative levels at least through the summer of 2019, and extending its slimmed-down quantitative easing program to at least the end of 2018. The second big driver, a worrying escalation of trade conflicts, came as the US implemented higher tariffs on a range of goods from its trading partners, including Canada, Mexico, the European Union, and most importantly, China, with each country retaliating, so ratcheting up the risk of a global trade war with all its negative consequences for global growth. The combination of a strong dollar and risk to trade was a near perfect storm for emerging markets, especially those with large dollar funding needs and most exposed to US trade. The potentially negative impact on China's growth was highlighted when the People's Bank of China, the Central Bank of China, took action to stimulate the economy by cutting reserve requirements of banks on the very day the higher US tariffs took effect. The Chinese renminbi was also allowed to depreciate, falling by 6% in the second quarter, so reversing all of its strength in the first quarter and negating some of the effect of higher tariffs. The political imperative of sustained growth continues to override the challenge of reining in excessive debt in the corporate sector in China. In contrast to China, which relies very little on dollar debt, runs a current account surplus and substantial foreign reserves, a number of more vulnerable emerging countries, including India, Indonesia, Turkey, Argentina, Brazil, were forced into raising interest rates to defend their currencies and offset the inflationary impact of currency falls. This in turn raises the risks of economic slowdown and damage to corporate earnings. It was no surprise then that emerging market equities and bonds were the weakest performing assets in the second quarter, a move which left valuations looking quite attractive both in absolute and relative terms. Geopolitics continue to have an impact on investor sentiment and markets. While North Korea stole the headlines, the thawing of relationships between the US and North Korea had no real impact on markets, the threat of nuclear war on the Korean Peninsula never having been priced into markets anyway. Of much more importance was the US withdrawal from the Iran nuclear deal, resulting in the reimposition of sanctions and reduced supplies of Iranian oil onto the global market. At a time when Venezuelan oil production was collapsing due to the implosion of effective governance, and OPEC and some non-OPEC countries continue to curtail production, the oil price surged 13% in the quarter, taking the rise so far this year to almost 20%. To date, there's been little follow-through into inflation, which generally has remained subdued. The biggest threat to inflation comes from the US, where the economy has been performing well. It's now being boosted by fiscal expansion in the form of tax cuts and additional government spending in a highly unusual pro-cyclical move. This comes at a time when unemployment is running at near record lows and amidst signs of some pickup in wage growth. An acceleration of wage growth could well be a trigger for the Fed to tighten policy more aggressively than currently envisaged. This undoubtedly poses one of the biggest risks to markets. So this is the key to future market direction. Geopolitical issues, trade wars, the threat to the long-term stability of the Eurozone from populism, specifically Italian politics, Brexit, instability in the Middle East. All of these have the potential to derail markets from time to time, and some are potentially globally important events, low probability but high impact. Yet to date, none of these have had any lasting impact on markets. The most worrying of them all, from a global economic perspective, the threat of trade wars, is so far affecting only a tiny proportion of global trade. Clearly, there's a risk of escalation and real damage through weaker business and consumer confidence and spending. But predicting the outcome of trade disputes when the lead protagonist is highly unpredictable is especially difficult. But it's quite possible that Trump is seeking political gain ahead of the midterm elections in November and is using threats to extract concessions which would play out well with his electorate. Ultimately, a negotiated settlement to the disputes is the most likely outcome, avoiding a damaging trade war which could bring the current global expansion to a premature end, something which all parties will be anxious to avoid. Ultimately then, it'll be US monetary policy which will determine the longevity of the current cycle. One of the most important effects of Fed tightening is that the return on risk-free assets has risen, notably US government bonds and cash, well illustrated by the yield of 2-year US government bonds, which reached a low of 0.5% in mid-2016. As recently as September last year, they were only 1.3%. Today, that yield is 2.6%, the highest since before the financial crisis, and now with a positive, real, inflation-adjusted return. This changes the relationship with riskier assets and puts pressure on their valuations. For the first time since the financial crisis, safe haven government bonds, albeit only in the US to date, are beginning to offer an acceptable yield. And this will change the way other riskier markets perform in the months ahead. Importantly, the global economy is in good shape as we enter this period of greater uncertainty and Fed tightening. The soft patch we saw in the first quarter is being followed by a pickup in growth through the second quarter, with generally strong or improving data. Leading indicators remain in expansionary territory, and there are few, if any, signs of capacity shortages and overheating that would push up inflation rapidly and trigger an unexpectedly steep tightening of monetary policy. The Fed is on course for policy normalization with further interest rate rises and quantitative tightening, yet monetary policy globally remains loose by any historical standard. The Fed is able to progress gradually to policy normality by virtue of the strength of the economy, clearly a good thing in itself. A combination of steady growth, modestly rising but still subdued inflation, and gradual monetary tightening is likely to keep bond markets under some pressure, with yields rising further, but not to levels which would undermine equity markets. Interest rates remain low by historical standards. Markets are undoubtedly more vulnerable to setbacks and greater volatility than in 2017 as the monetary tightening cycle progresses and as fears of damaging trade wars ebb and flow. However, the underlying strength of the global economy remains largely intact, and the pace of monetary stimulus withdrawal will be cautious. It's just too early to be calling an end to this cycle. Yes, risks have increased this year. The Goldilocks environment of 2017 has been replaced by greater uncertainty and tighter financial conditions. But this is being reflected in valuations. Strong growth in corporate earnings this year and flat markets have improved valuations of equity markets materially. In bond markets, yields have risen, making today's entry point more attractive. We continue to believe that shorter duration exposure is appropriate, and we're increasingly cautious about credit as interest rates rise, but we are beginning to see some value arising in US Treasuries. And as we've seen throughout this long cycle, periods of weakness in markets have provided good entry points for longer term investors. And such an opportunity is opening up today in emerging markets, which have fallen sharply from the peaks earlier this year. Overall, we believe it remains appropriate to stay invested, building greater resilience in portfolios through more defensive assets, while at the same time taking advantage of these valuation opportunities as they arise.